Discover the secrets of Peter Lynch, the legendary fund manager, in Peter Lynch, How to Invest for Beginners. Learn why he believes small investors have an advantage, how to identify good companies, and overcome market inefficiencies. Lynch shares insights on stock categories, risk management, and essential characteristics. Don't miss out. Watch until the end, subscribe to the channel for more exclusive investment content. Uncover the mysteries of the market with Lynch's wisdom.
5. Peter Lynch's investment insights. Renowned fund manager Peter Lynch emphasized the potential for small investors to gain significant advantages over financial professionals by applying their everyday knowledge. Lynch's unconventional background in history, psychology, and political science set him apart from conventional financial market participants. While many fund managers struggle to outperform market indices, Lynch boasted a remarkable average annual gain of 29.2% over nearly 2 decades. His unique educational perspective, viewing investment as an art and disregarding traditional business school institutions, was crucial to his success. The manager highlighted the importance of insights from ordinary people about products, stores, and restaurants. He grounded his approach in the concept that investing in what you know and understand is a solid strategy. Lynch saw stocks not only as market instruments but as actual stakes in companies. His singular focus on companies, rather than macroeconomic factors, reflects a more holistic and practical approach to investment, countering the conventional market mindset. Lynch's criticism of the market's slowness and misplaced focus, especially fund managers' reluctance to buy stocks without analytical coverage, underscores the limited efficiency of the current system. He pointed out that individual investors and workers have the ability to identify trends in real time, a skill that often surpasses the market's ability to recognize them promptly. Lynch, considering stocks as actual ownership of companies, provided a valuable perspective that transcends the traditional market view. Lynch not only shared his investment lessons and approaches but also outlined specific stock categories. By categorizing them according to growth, turnarounds, undervalued assets, and other factors, he provided a practical guide for investors. This segmentation offers a clear view of the different risk and return profiles associated with various asset categories. His emphasis on undervalued assets and companies with hidden value highlights the need for investors to consider not only past performance but also unrecognized potential in assets.
4. Market inefficiencies and investor advantage. Peter Lynch, through his critiques, revealed underlying inefficiencies in the functioning of the financial market, pointing to the slowness and mistakes present. Specifically, he lamented fund managers' hesitation to acquire stocks without analyst coverage. According to Lynch, this reluctance reflects the market's slowness in recognizing investment opportunities outside the traditional scope. The manager emphasized, forcefully, the advantage that individual investors and workers hold. Their diverse experiences provide the ability to identify market trends in real time, giving them insight often superior to the market's ability to promptly absorb these changes. This advantage, outlined by Lynch, highlights the opportunity investors have to anticipate and react more agilely to market dynamics compared to institutional managers. Lynch's view of stocks as actual stakes in companies, not just market instruments, permeates his entire investment philosophy. This unique perspective encourages a more focused and personalized approach to investment, countering the often homogeneous mindset adopted in the financial world. By seeing stocks as tangible properties in real companies, Lynch encourages investors to consider not only market movements but also the health and underlying fundamentals of the companies they invest in.
3. Risk management and investment knowledge. Peter Lynch, addressing risk management in the context of investments, shared valuable insights into the dynamics between risk and return in the financial market. He guided that, on average, stocks present both profit potential and higher risk than fixed income investments. This perception underscores the need for a cautious and informed approach in investment decision-making. Lynch's advice reinforces the importance of risk mitigation through a deep understanding of the companies included in an investment portfolio. The manager emphasizes the need for individual investors to conduct comprehensive research, analyzing not only companies' products but also their financial structure, performance history, and dividend policies. This grounded approach seeks to provide a holistic view of companies, enabling investors to make informed decisions aligned with their financial goals. Additionally, Lynch highlighted crucial personal qualities for success in the investment universe. Patience was highlighted as an essential virtue, recognizing that returns often take time to materialize. Self-confidence, common sense, and risk tolerance are characteristics that, according to Lynch, contribute to a balanced and resilient decision-making process. Humility is emphasized as an important counterpoint, reminding investors of the need to learn from mistakes and adapt their strategies as necessary. Persistence, finally, is pointed out as a fundamental attribute for facing the challenges and inherent fluctuations in the long-term investment world.
2. Stock categories according to Lynch. Peter Lynch's categorization of stocks provides a valuable framework for investors to understand and assess different investment opportunities. Lynch identified 5 main categories: slow growers, moderate growers, fast growers, turnarounds, and undervalued assets. In the slow growers category, Lynch focused on companies that demonstrate stability but with a more gradual pace of expansion. These organizations usually operate in mature sectors and present a more moderate risk profile. On the other hand, the moderate growers category includes companies with a slightly above-average profit growth history compared to the market average. These companies seek a balance between growth and stability, providing investment opportunities in dynamic sectors. The fast growers category encompasses companies in emerging sectors or with innovative products/services, offering high return potential but accompanied by higher volatility. Lynch emphasized the need for a riskier approach to investing in this segment. Turnarounds represent companies that, after facing challenges in the past, are undergoing positive changes such as restructuring and improvements in fundamentals. These companies can offer profit opportunities as they recover. Finally, Lynch emphasized the importance of recognizing undervalued assets and neglected market segments. Undervalued assets may include physical properties, patents, or natural resources whose true value has not yet been realized by the market. By highlighting these categories, Lynch encouraged investors to explore opportunities beyond the conventional, seeking sectors and assets that are often underestimated and overlooked by the market in general.
1. Characteristics of good companies according to Lynch. Peter Lynch, discussing the characteristics that define good companies, presented a unique and valuable perspective to guide investors in their choices. One highlighted characteristic by Lynch is the mundane or even repugnant nature of the business. Contrary to the pursuit of glamour, he recognized the potential of companies operating in unattractive sectors, such as funeral services or garbage collection, emphasizing that the lack of competition can consolidate these companies as leaders in their niches. Lynch's preference for companies operating in stable or declining industries is also a distinctive characteristic. He argued that, in these scenarios, competition is less intense, allowing the company to establish itself as a market leader. Additionally, the manager valued the presence of a market niche, reducing competition and ensuring that people continue to buy the company's products or services regardless of economic conditions. The strategic use of technology to reduce costs was another point highlighted by Lynch. Companies that adopt innovative technologies not only improve their operational efficiency but also demonstrate an ability to adapt to changes in the business environment. Lynch emphasized the need for investors to closely monitor the company's movements regarding technology adoption. Finally, Lynch cautioned against the hasty pursuit of the next big thing and over-diversification into low-quality assets. He underscored the importance of focusing on a few strong companies instead of dispersing investments in several weak ones. Additionally, the manager warned against investing in companies overly dependent on a single client or a small number of clients, recognizing the significant risks associated with this concentrated dependence. Lynch's guidelines offer a balanced and pragmatic approach to identifying good companies.
In concluding our journey through Peter Lynch's insights, we recognize the wealth of knowledge he shared about investments. If these lessons resonated with you, don't forget to leave a like and share your thoughts in the comments. If you want to uncover more financial secrets and receive regular updates, don't forget to subscribe to the channel. Your participation is crucial to building a strong and enriching community. Together, let's explore further the paths to financial success. Until the next video, investors.